What is going on, guys? Today we're going to be talking about the differences between credit spreads and debit spreads. Now I have two separate videos on credit and debit spreads, so be sure to go check those out. So I'm just going to show you guys the main differences and similarities of these option strategies, both the debit spread and the credit spread. And yeah, just tell you a little bit about what they're used for and a few strategies you can go on, and maybe just get more information and understanding on credit and debit spreads and why people use them. So we have this Boeing debit spread right here to buy the 350, sell the 352.5 call. And what this is saying is that if BA goes above 352.5, we're able to buy the shares at 350, and then we have to sell them to someone at 352.5. And when you're putting in a debit spread, as you'll see, we'll go in here and go to the one I have, and then you sell the one farther out of the money. Then it gives you a total cost. Whereas a credit spread, you would be selling the 350 and buying the 352, and you would get a total credit of $33. So you would get this credit up front, but instead on this credit spread we would have a risk of $217, whereas on the debit spread we only had to pay for this $33. But these are saying two different things. The credit spread is saying that this contract is not going to go above 350 or 352 by expiration, and the debit spread saying it's going to go above 350 and 352 by expiration. The same thing on the put side, but exact opposite. As always, if we were to sell the 305 here and buy the 302.5, we'd get a credit of $58. But what this is saying is that Boeing will not go below 302.5, and if it does, we'll lose our total credit plus our risk. The risk in this play is 192, and if we were to do the debit spread, we would sell the 302.5 and buy the 305, and we'd have a total cost of 58. So we wouldn't have a risk of 162 like the other play, but what this is saying is that Boeing is going to go below 302.5 by expiration. Now, a big difference about these plays is that when you're doing a debit spread, you want it to go in the money so you can get the full amount of your spread. In this case, it would be 250 because you minus 305 and 302.5. You're left with 2.5 times 100. That's 250. You could do that even if you sold the 300. You would be getting a $110 credit, but you'd have a $390 risk in this case because the spread's wider, and the share would have to go to 297.5 for you to get the full amount. And that's another big key, is about the placement. When you're doing a credit spread, you can pick up some small credits, and that play is actually really good because Boeing doesn't really drop below down to 300. So you would probably collect the $58, but if you want to get a little more risk and put in less money, you could come up here to the closer to the in the money contracts, maybe even sell this one that is in the money and buy this one. You get a credit of 120 and your risk is only 130. You could even go deeper in the money. Say you want to sell this 330 and buy this one, you get a $150 credit, and then you would only have a $100 risk. And we are pretty far out in expiration. From my experience, the shorter the expiration, the more potential credit you can get from these in the money plays. If you're trying to get a $20-$30 credit spread, you're gonna probably have to be like in the money. We can check out Home Depot. Home Depot has some pretty good credit spreads. See, we could sell this 237.5 and buy this 235. We get a $190 credit. That's only $60 of risk, so that's not too bad. And this play is pretty decent considering Home Depot can move pretty quick in a week. So that's a pretty decent play, but you do have assignment risk because you're selling a contract in the money, so you always got to be aware of that. You can get assigned on this. That's why they give such high credit, is because of that assignment risk. So you probably want to get a play that only has like $30-$40 of risk at the most if you're doing an in the money credit spread, but it's really all up to you. You might think of a better play than I think about. I just like low risk, high reward plays. That's on the put side. Say we thought Home Depot was going to drop and we didn't think it was going to go up. We could do a debit spread down here for even cheaper than that. We could buy this 225 and sell this 222.5 for $19 of risk, which is very minimal, but that's a pretty hard play to hit because Home Depot's been doing nothing but running up. So of course you got to plan before you make your play. But I'm just trying to show you guys the possibilities and the differences. I think the most simple way to explain it would be if you sell a credit spread, you want your options contracts to end out of the money to get the maximum gain. And if you're buying a debit spread, you want your options contracts to go in the money to get the maximum gain, whether you have a $500 spread, a $250 spread like this one. But that's really your objectives when you're selling these spreads. On credit, you want to be out of the money. On debit, you want to be in the money. But you can sell your options contracts at any time. So if they're up 200-300%, you can get out of that play, make $20-30 depending how much you spent, or you can just ride that contract to the wall. But be sure to punch yourself in the nuts first, because it could be up $100 and you could make $100 right there. But just as quick as it was up $100, it can be down back to $20-30 profit, or maybe you're losing on the play now. These spreads are so volatile, especially when they're getting close to expiration. They can expire almost instantly. If the stock has a melt up or melt down that's not in your favor, you are going to lose on these contracts if you're like really close to your expiration. So getting time is always helpful. Be sure to paper trade, because paper trading will get you used to these spreads and you'll be able to figure out new strategies by yourself, maybe ones that I didn't even mention here, because I'm pretty simple. I just go for low cost plays that have decent percentages, like 1,000, 2,000%. That's what I'm looking for, maybe even more if I can. There's some plays out there where you don't pay that much and you can make a lot. So there's just a lot of strategies out there. So the more you learn about options, just the more dangerous you're going to be. You're going to be making so much profit. Everyone's going to be so proud of you as long as you just keep staying consistent and not gambling your money away. Be tactical, snipe plays, paper trade, just learn the craft. Don't be scared to keep learning, because if you want to trade, you have to keep learning. I learn something new almost every single day, and it's amazing. That's why I love trading. So if you guys enjoyed this video, be sure to leave a like, subscribe to the channel. We're live Monday through Friday, market open to market close. If you have any questions, leave them in the comments below, and I'll see you guys in the next video.